Picture this. You wake up tomorrow. Your phone costs 40% more. The shelves at the store look thinner. A factory in Ohio shuts down. A factory in Guangdong does the same. And every politician on TV says the same line. This is the price of independence. Here's the uncomfortable truth. If the U.S.-China economic relationship breaks, there is no clean winner. There is only a bill, and it's sent to people who never voted on it. That's what this story is about. Not slogans, not flags, not trade war theatrics, but who actually loses when the world's biggest economic relationship snaps, and why the answer is not who you've been told. Let's start with why this suddenly matters again. For most of the last 40 years, the U.S. and China built something enormous together. Not an alliance, not a friendship, a machine. America consumed, China produced. Money flowed one way, goods flowed the other. It wasn't romantic, it was brutally efficient. But now that machine is grinding. Tariffs, export bans, tech blacklists, national security reviews of toasters. Both sides say they're decoupling, pulling apart, protecting themselves. That sounds clean, controlled, almost surgical. It isn't, because you can't unplug a machine this big without sparks. To understand who loses, we need to understand what this system actually is, not in theory, in practice. Forget trade charts for a moment. Think of the U.S.-China relationship as a giant factory split across the Pacific. Design, branding, finance, software, and consumption mostly sit in the U.S. Manufacturing, assembly, scale, and supply chains mostly sit in China. One side is the brain, the other is the body. You don't need to like that analogy, you just need to notice what happens if you separate them. The U.S. didn't lose manufacturing by accident. It outsourced it because it made things cheaper, faster, and more profitable. China didn't steal its way into factories. It offered labor, infrastructure, and patience when others wouldn't. By the early 2000s, this system locked in. An iPhone is designed in California. Its parts come from over 40 countries. Most are assembled in China. That phone is sold back to Americans. The profits go to Apple. The wages go to Chinese workers. The savings show up as lower prices. Everybody tells a story where they're the hero. Now here's the part most people miss. This wasn't just about goods. China took the dollars it earned and recycled them back into U.S. government debt. China didn't just sell America stuff. It funded America's deficits. At its peak, China held over $1 trillion in U.S. treasuries. That kept U.S. interest rates lower than they otherwise would be. Cheaper mortgages, cheaper loans, cheaper government borrowing. So when people say China needs the U.S. market, that's true. But when they say the U.S. doesn't need China, that's incomplete. This was a loop, not a one-way street. Now let's talk about what breaking up actually means. It doesn't mean trade goes to zero. That's fantasy. It means friction, delays, duplication, higher costs everywhere. Companies start asking, can we make this without China? Can we sell this without America? And the answer is usually yes, but not cheaply, not quickly, and not without damage. Let's start with the obvious losers everyone talks about, Chinese exporters. If the U.S. buys less from China, Chinese factories feel it fast. Margins are thin. Competition is brutal. A 10% drop in orders can wipe out a firm. That's real pain. But here's the quiet irony. China has been preparing for this for years. It's shifting toward domestic consumption, selling more to itself, selling more to Southeast Asia, Africa, and Latin America. The U.S. is still important, but it's no longer everything. Now look at the other side, American consumers. Tariffs don't punish countries, they punish buyers. If a $500 appliance suddenly costs $650, that's not China paying the tariff, that's you. And when supply chains move, costs don't just rise once, they rise again and again. New factories cost more. New workers cost more. New logistics cost more. Those costs don't disappear. They embed themselves into prices. Inflation becomes structural.
Now let's talk about the group nobody puts on posters. American companies. Big ones, famous ones. Companies that spent decades optimizing supply chains across China. Companies whose profits depend on scale and precision. Decoupling means rebuilding everything. New suppliers, new compliance, new risks. That's not patriotic. That's expensive. Some firms can absorb it, many can't. Margins shrink, stock prices wobble, investment slows. And then there's the workers. Not just Chinese factory workers, American workers in logistics, retail, ports, design, marketing. Jobs tied to trade flows, not factory floors. When volume drops, those jobs don't get speeches. They just quietly vanish. Here's where the math gets uncomfortable. Breaking the system doesn't reduce dependence, it shifts it. Factories don't teleport from China to the US overnight. They move to Vietnam, India, Mexico. That's not decoupling, that's rerouting. China may lose some assembly work, but it often keeps the parts, the materials, the know-how. The US feels morally satisfied. The spreadsheet barely notices. Now let's zoom out, because the biggest losses aren't bilateral, they're global. The US-China relationship is the backbone of world trade. When it weakens, uncertainty rises everywhere. Companies delay investment, countries hedge, capital becomes cautious. Global growth slows not because of one decision, but because everyone starts waiting, and waiting is poison for economies. Then there's technology. This is where things get sharper. Semiconductors, AI, advanced manufacturing. Both sides want control. Both sides fear dependence. So the world splits. Two standards, two ecosystems, two internets eventually. That sounds abstract. It isn't. It means duplication of effort, slower innovation, higher costs for everyone. Progress becomes less efficient. The irony is thick. In trying to become safer, the system becomes weaker. Now let's talk about power. The story you often hear is simple. If the US cuts China off, China collapses. If China cuts the US off, America shrugs. Reality is messier. China loses growth, but authoritarian systems are built to absorb pain. The US loses price stability, and democracies are allergic to sustained discomfort. Higher prices hit voters fast, and voters have opinions. So who really loses? Not governments, at least not first. They can borrow, print, delay. The real losers are ordinary households navigating higher costs, small businesses without leverage, workers caught in transitions nobody prepared them for, and the global system that made things cheaper, faster, and more connected than ever before. This doesn't mean the old system was perfect. It wasn't. It created inequality. It hollowed out communities. It concentrated power. But breaking it without a replacement doesn't fix those problems. It just rearranges them. Here's the final uncomfortable thought. Economic relationships don't end with explosions. They erode, slowly, quietly, through paperwork, regulations, and temporary measures that never go away. And by the time everyone agrees it was a mistake, the system is already gone. So when you hear the question, who loses if the US-China relationship breaks, the most honest answer is this: the people who never thought they were part of it, and the world that quietly depended on it working. The real question isn't whether the breakup happens, it's whether anyone is ready for what replaces it.